Do not let the green candles on your screen deceive you into a false sense of security regarding the current market structure. While the price of Bitcoin has reclaimed the $68,000 level, there is a massive divergence forming beneath the surface that most retail investors are completely ignoring. We are seeing a significant thinning of order book liquidity on the bid side, combined with a historic spike in leveraged open interest across offshore derivatives platforms. The reality is that while the price is moving up, the foundation supporting this price action is becoming increasingly fragile with every $100 increase. If you are currently sitting on a significant position or looking to deploy capital, you are walking into a potential liquidity trap where the smart money is positioning to distribute while the crowd is rushing to accumulate. You need to understand exactly where the capital is coming from, because not all buying pressure is created equal. In the next few minutes, I am going to walk you through the specific on-chain data and institutional flow metrics that determine if this rally is a genuine return of quality capital or just another leverage-fueled illusion. I will show you the exact difference between the paper demand driving prices today and the spot demand that drove the all-time highs of the past. Let us get into the weeds of what is actually happening behind the scenes of this recovery. To understand the legitimacy of Bitcoin returning to $68,000, we must first dissect the source of the funds entering the ecosystem. The most critical metric we are tracking right now is the ratio between spot volume and futures volume. When we analyze the data from the last 72 hours, we see that the impulse move upward was initially triggered by the spot market, but the follow-through has been heavily dominated by the futures market. This is a classic signal that speculative leverage is outpacing genuine organic demand. Here's why this matters to your portfolio strategy. When the market is driven by quality cash flow, we see a sustained rise in the balances of accumulation addresses, which are wallets that have a history of buying and never selling. However, the current data suggests that while accumulation addresses are active, their buying intensity has not matched the ferocity of the price increase. This creates a delta that is usually filled by high-frequency trading algorithms and leveraged retail traders chasing the momentum. We call this low-quality cash flow because it is capital that is extremely sensitive to volatility and will exit the market at the first sign of trouble. The reality is that true institutional capital does not chase green candles. It accumulates during the red ones. If we look at the 30-day moving average for exchange inflows, we are seeing a slight uptick in deposits to major exchanges. This indicates that some long-term holders are moving coins out of cold storage to prepare for potential distribution at these higher price levels. This is not necessarily a bearish signal that a crash is imminent, but it is a clear warning that the supply side is waking up. We must also look at the behavior of the spot exchange-traded funds. While the headlines are celebrating net positive inflows, the granular data reveals that the velocity of these inflows has slowed down compared to the first quarter of the year. The initial wave of pent-up institutional demand has largely been satisfied, and we are now in a phase of passive allocation. This means that the exchange-traded funds are no longer the aggressive market bidders that can single-handedly absorb all selling pressure. They provide a floor, certainly, but they are not currently acting as the rocket fuel for a parabolic advance. Another factor we need to consider is the stablecoin supply ratio. This metric acts as an oscillator for the buying power currently sitting on the sidelines. Right now, the stablecoin supply on exchanges is high, which theoretically is bullish because it represents dry powder ready to be deployed. However, the conversion rate of this stablecoin supply into Bitcoin has remained sluggish. Investors are holding cash equivalents, waiting for a confirmation of the trend rather than blindly buying the breakout. This hesitation is a hallmark of smart money behavior. They're waiting to see if the $68,000 level flips from a ceiling of resistance into a floor of support. If this analysis helps you separate the signal from the noise, feel free to join our inner circle by subscribing for more deep dives into market mechanics. Now, let us turn our attention to the derivatives market, which is currently the elephant in the room. The funding rates across major exchanges have turned positive, indicating that traders are willing to pay a premium to hold long positions. While positive funding is normal during a bull market, excessive funding rates often precede a leverage flush. We are seeing open interest build up to levels that rival the peaks of late 2021. This is dangerous because it implies that a large portion of the market is betting on the same outcome with borrowed money. If the price of Bitcoin were to drop by just 5%, it could trigger a cascade of liquidations that would force the price down much further. This is the opposite of quality cash flow. It is fragile capital that creates structural weakness in the price action. Furthermore, we need to analyze the cost basis of the short-term holder cohort. These are investors who have held Bitcoin for less than 155 days. Currently, the price is trading well above their average cost basis, which puts virtually every recent buyer in profit. Historically, when 95% or more of the circulating supply is in profit, the market incentive shifts toward taking profits. We are approaching a zone where the temptation to sell becomes mathematically irresistible for swing traders. The smart money knows this, and they are likely setting their limit sell orders just above the current price action to provide liquidity for the breakout buyers. This transfer of wealth from the impatient to the patient is the oldest mechanism in financial markets. Another critical component of quality cash flow is the corporate treasury behavior. We have seen a few minor announcements of corporate purchases, but we have not yet seen a second wave of major tech companies adding Bitcoin to their balance sheets. Until we see that narrative reignite, the rally relies heavily on the existing cohort of believers. The macroeconomic environment also plays a pivotal role in defining the quality of capital flows. With interest rates hovering at elevated levels, the opportunity cost of capital is high. Institutional allocators are weighing the risk-free rate of government bonds against the volatility of digital assets. For quality cash flow to return in force, we need to see a clear signal from the Federal Reserve regarding liquidity injection. The correlation between global M2 money supply and Bitcoin price action remains one of the strongest statistical relationships in this asset class. Currently, global liquidity is expanding slowly, but it has not reached the flood stage that characterized the previous bull run. This suggests that while the trend is upward, the slope of the ascent will be more grinding and less explosive. It is a market for stock pickers and strategic allocators, not for blind speculation. The distinction between a rally driven by spot buying and one driven by futures is the difference between a building made of concrete and one made of straw. Spot buying removes supply from the market permanently, creating a supply shock. Futures buying merely bets on the price, without affecting the underlying scarcity of the asset. Our proprietary indicators show that the ratio of spot to futures volume is improving, but it has not yet reached the gold standard levels we saw in early 2021. This means we are in a transition period. The market is attempting to graduate from a speculative recovery to a fundamental expansion. This transition is often messy, volatile, and filled with false breakouts. If you appreciate this level of unfiltered market intelligence, consider subscribing to ensure you never miss a critical update. We also need to discuss the behavior of miners. Following the halving event, miner revenue was slashed, putting pressure on less efficient operations. We have observed a period of miner capitulation, where reserves were sold to cover operational costs. That selling pressure seems to be exhausting itself, which is a positive sign. When miners stop selling, a significant source of structural supply is removed from the market. However, the absence of selling is not the same as the presence of buying. It's simply the $68,000 mark is psychologically significant because it sits just below the all-time high territory. Human psychology dictates that investors are hesitant to buy near the top for fear of being the greater fool. Therefore, the volume profile shows a tapering off as we climb higher, which is a bearish divergence. Ideally, you want to see volume expanding as price increases, confirming that more participants are agreeing on the higher valuation. So, what is the verdict on the quality of this cash flow? It is a mixed bag. We have a baseline of institutional support via the exchange-traded funds, which provides a higher floor than in previous cycles. However, the marginal buyer driving us from $60,000 to $68,000 has been largely speculative. This suggests that we are vulnerable to a short-term correction to flush out the leverage before the true quality capital steps in to push us into price discovery. The smart money is likely waiting for a retest of lower support levels to build their long-term positions. They are not chasing this candle. They are waiting for the dust to settle. You must adopt the same mindset if you wish to survive in this volatility. So, what is the playbook for the coming weeks? First, do not chase the green candles at resistance. Wait for a confirmed breakout above $70,000 with significant volume, or wait for a retest of the $62,000 to $64,000 range to deploy fresh capital. Second, monitor the funding rates. If they reset to neutral while price consolidates, that is a bullish signal. If they continue to spike while price stalls, prepare for a flush. Third, watch the spot premium on Coinbase. If the price on Coinbase is higher than the price on offshore exchanges, it means American institutions are buying. which is the ultimate sign of quality cash flow. Currently, that premium is flat, indicating indecision. Patience is your greatest edge in a market that is trying to trick you into acting prematurely. The return of quality cash flow is underway, but it is not yet fully confirmed. Navigate accordingly. Please remember that I am a market strategist analyzing data, and this content is for educational and informational purposes only. Nothing I have said today constitutes financial advice, investment advice, or a recommendation to buy or sell any assets. Markets are inherently risky, and you should always conduct your own due diligence and consult with a certified financial professional before making any investment decisions.